The lock-in effect didn't just slow the market, it buried it. Homeowners sitting on 3% mortgages are refusing to sell, and the result is the lowest housing turnover in decades, 4.7% annually, a number that hasn't budged since 2023. Meanwhile, buyers can't afford to enter. The market isn't frozen by a crash, it's frozen by a standoff. And California is caught directly in the crossfire. If you're tired of channels dressing up bad news and optimism you didn't ask for, hit subscribe and stick around. This channel gives you the straight read on what's actually happening before it hits the headlines. Now let's get into it, because what we're looking at in early 2026 is something genuinely unusual in American economic history. This isn't a classic housing downturn where prices fall fast and the bottom is obvious. This is something more insidious, a slow-motion freeze where the normal rules of supply and demand have essentially stopped working. And to understand why, you have to picture what happened to the housing market like a river that got dammed from both ends simultaneously. On one side, you have sellers who will not move. On the other, buyers who cannot afford to move. And right in the middle, a stagnant, airless pool of inventory that isn't clearing, isn't refreshing, and isn't reflecting any kind of natural market equilibrium. That's where we are right now. Let's start with the demand side, because the collapse in buyer activity is the kind of number that should genuinely stop you in your tracks. Mortgage applications in early 2026 are sitting 40% below pre-pandemic levels, not below last year, below the period before any of the pandemic distortions hit, meaning even when you strip out the frenzy of 2021 and 2022, demand is dramatically weaker than what was considered normal in 2019. Existing home sales just hit a range that analysts are calling a 25 to 30-year low, and buyer demand overall is 27% below pre-pandemic norms. 27%. That's not a seasonal dip. That's a structural withdrawal from the market by a generation of would-be buyers who ran the math and decided to stay on the sidelines. And here's where it gets personal for you, because this isn't abstract. If you're a renter right now wondering whether to buy, consider this. The typical monthly mortgage payment on a median-priced American home is sitting at approximately $2,700 per month. That figure consumes roughly 37% of median household income. The last time the payment-to-income ratio was this elevated was 2026. Not 2026 as in now, 2006. As in the year before, the entire housing market collapsed into the worst financial crisis since the Great Depression. Now, I'm not saying we're heading for a repeat of 2008, and I'll get to the important distinctions in a moment. But when you're standing in the same statistical territory that preceded that collapse, you do not get to ignore the signpost. Renting in most major U.S. markets right now costs 30 to 40% less per month than owning an equivalent property. That's not a small gap. That's the market telling buyers in plain language, not yet. What makes this especially confusing is that the Federal Reserve did what it was supposed to do. Rates came down. Starting in August of 2024, the Fed began cutting. By early 2026, the federal funds rate trajectory had pulled mortgage rates from around 5.5% down toward 3.7%. That is a meaningful reduction. By any traditional economic model, that should have unlocked demand, stimulated applications, and restarted the transaction engine. It didn't. Applications stayed flat. Sales stayed depressed. The stimulus that was supposed to work worked on paper, but not in reality. And that's a warning sign of a different order entirely. It means the problem isn't just the cost of borrowing, it's the underlying price of the asset itself. Homes have been priced so far beyond what incomes can support that even cheaper debt doesn't make the math work. Think about it this way. Imagine you're trying to fill a bathtub with the drain open. The Fed cutting rates is like turning the faucet on a little harder, but if the drain, the affordability gap, is wide enough, the tub never fills. That's the dynamic we're watching play out in real time. Now let's move to the price side, because this is where the situation gets both more complicated and more dangerous depending on where you're sitting. The national median home price in January of 2026 rose just 0.9% year over year. That sounds benign. It's not when you understand what it's masking. That thin national average is the product of severely distorted regional data, some markets holding up and a growing number actively correcting, averaging out to a number that looks almost stable but tells you almost nothing useful about what's happening on the ground. Denver is down 3.1% year over year. Phoenix is down 3.1%. The West Coast overall is off 1.4%. These are not rounding errors. These are corrections in markets that were among the most aggressively bid up during the pandemic era, and they reflect a repricing that has further to go because the underlying affordability fundamentals never supported those price levels in the first place. New construction prices nationally have come down 15% from their peak in fall of 2022, meaning builders have already accepted that the market has moved. Existing sellers have not fully accepted this yet, which is creating a dangerous tension between where prices are being listed and where the actual clearing price is. And then there's the equity picture, which is the part of this story that gets discussed least and matters most to individual homeowners. Right now, 1.1 million American homeowners are in negative equity. That means they owe more on their mortgage than their home is currently worth. That's the highest that number has been since 2018. Another 3.2 million homeowners hold less than 10% equity, a paper-thin cushion that evaporates quickly if prices decline even modestly in their market. In places like Ocala, Florida, some homeowners who bought at peak 2022 prices are sitting on losses of 40%. 40%. If you bought a home in Ocala for $350,000 in the spring of 2022, that home may be worth closer to $210,000 today. That's not a paper loss you can wait out over a few years. That's a financial restructuring of your entire life. Florida is worth dwelling on here because it serves as a kind of case study in what happens when migration-driven demand evaporates and the supply that was built to service it stays behind. Florida's net migration, the number of new residents arriving minus those leaving, crashed from 310,000 people in 2022 down to just 22,000 in 2025. That is a decline of over 90% in the net inflow that was fueling one of the hottest real estate markets in the country. Think about what that means for a market like Lakeland or Cape Coral or parts of the Tampa metro. Developers built units expecting the demand pipeline to keep flowing. Investors bought second homes and short-term rental properties expecting the flood of new buyers and renters to sustain yields. And then the migration tide went out, and what was revealed was exactly what Warren Buffett's old line predicts. You find out who's been swimming naked when the tide goes out. Lakeland, Florida, to put a specific number on it, is sitting with approximately 11% of homes in or near negative equity territory. That's not a city on the economic margins. That's a city that was being sold as a Sunbelt success story as recently as 2 years ago. The insurance cost crisis in Florida has compounded everything. When your homeowner's insurance premium jumps from $1,800 a year to $6,000 a year because carriers are pulling out of the state, that changes the monthly math on owning a home in ways that no mortgage rate cut can offset. We're seeing sellers in Florida now being forced into the market not because they want to sell, but because the carrying costs, insurance, property taxes that reassessed at peak values, and HOA fees that have surged make holding the asset economically unsustainable. That's distressed supply hitting a market that already doesn't have enough buyers. And when distressed supply meets absent demand, there is only one direction prices can go. Texas tells a similar story. Net migration into Texas fell 70% and from approximately 220,000 annual net arrivals down to 67,000. Austin, which was being compared to Silicon Valley during the pandemic boom, has been one of the sharpest corrections in the entire country. The overbuilding that followed the migration surge has left certain Texas metros with excess inventory that the current organic buyer pool simply cannot absorb at current prices. And unlike California, Texas doesn't have the structural supply constraints, the mountains, the coastlines, the restrictive zoning that have historically put a floor under prices. Texas built, and it built a lot, and now some of that building has no obvious buyer. Las Vegas gives us another data point worth examining. 2025 home sales in Las Vegas came in at just 28,500, a figure well below what the market needs to absorb given its construction pipeline and investor activity from prior years. Vegas is a market that runs hot and cold in extreme swings, but even by Vegas standards, this level of transaction volume suggests a market that is genuinely struggling to find its equilibrium. Meanwhile, New York State shed 137,000 net residents over the past year. The traditional assumption was that those New Yorkers were heading south, and for a period, they were. But the data now shows that migration flow has slowed dramatically. The people leaving New York are not landing in Florida or Texas at the rates that briefly turbocharged those markets. Some are going to the Carolinas. North and South Carolina remain among the few Sunbelt destinations still posting positive net migration, but the mega wave that repriced the Sunbelt has broken, and this matters deeply for California because for the past several years, one of the few bullish arguments for California real estate was that even with its own outmigration problem, the state wasn't being flooded by cheap construction the way Texas and Florida were. California's restrictive zoning and supply constraints were, paradoxically, a floor under prices. That argument still has validity, but it's getting weaker as demand declines in tandem with supply stagnation, and it does nothing for the regions where prices were already stretched to breaking point. Let's talk specifically about California because this is where the data gets genuinely schizophrenic, and you need to be careful about who you're listening to. The California Association of Realtors, C.A.R., has forecast a 3.6% price increase for 2026, targeting a statewide median of $905,000. That is an optimistic projection, and it may ultimately prove correct, but it needs to be held alongside the actual January 2026 data, which tells a different story. The statewide median in January 2026 was $780,200, down 0.72% from the prior year. Active listings stood at 85,159 homes, itself down 3.3%, meaning even the supply side is contracting. January sales came in at 15,606 transactions, down 6% year over year. Supply sits at 4 months, technically what you'd call a balanced market, but the velocity of transactions is deteriorating. Now zoom into the regions and the picture sharpens considerably. Riverside County is down 2.4% year over year. Northern California markets are declining. Q4 of 2025 posted a statewide quarterly decline of 2.2%. The West Coast overall, as we mentioned, is off 1.4% year over year. The Bay Area is holding on relatively stable medians. But before you use that as comfort, understand what's holding those numbers up. It's not demand strength, it's near record low inventory. When there are almost no homes for sale in a market, the few that do transact tend to clear at elevated prices because desperate buyers compete for a scarce resource. That isn't a healthy market. That's a market frozen in place by the same lock-in effect we described at the open. Here's the number that should concern every California policymaker and every California homeowner in equal measure: 18%. That is the percentage of California households that can currently afford to purchase the median-priced home in the state. 18%. Think about what that means. It's more than 8 in 10 California households are priced out of the median home. That's not a housing affordability problem. That's a structural market failure, a market that has priced itself beyond the reach of the overwhelming majority of the people who live in it. And markets that do that don't stay there forever. They either correct or they hollow out. California has been doing both simultaneously, correcting in the inland and peripheral regions while hollowing out in the coastal cities where the young and the working class simply cannot afford to put down roots. The political dimension of this crisis is something most financial analysts ignore, but on this channel we don't have that luxury because the politics of housing in California are about to get significantly louder. Governor Newsom's housing production agenda has stalled. Local jurisdictions across the state have found ways to slow walk or block state-mandated housing elements. And if prices continue softening in Riverside, the Inland Empire, San Bernardino County, the places where working-class Californians went when they couldn't afford the coast, you are going to see a renewed political insurgency from inland legislators who are tired of policies written in Sacramento that protect coastal property values at the expense of everyone else. That conflict has real budget implications. It has zoning implications, and it could fundamentally reshape the political map of California housing policy in ways that won't be resolved in 2026, but will be set in motion by what happens in these next 12 months. Now, I want to come back to the Fed and the policy question because this is where the analysis gets most unsettling. The traditional playbook for a housing slowdown is cut rates, reduce the cost of borrowing, stimulate purchases, stabilize prices, restart the engine. The Fed executed that playbook. Rates came down by roughly 180 basis points from the peak, and the engine didn't restart. That tells you something profound about the nature of this slowdown. It's not primarily a credit problem, it's a price problem. Homes are simply priced beyond what a rate cut can bring into reach for the median buyer. And until that gap closes, either through prices falling, incomes rising dramatically, or some combination of both, the rate lever doesn't have the power we've historically expected it to have. Sish, what's potentially worse? If the Fed is forced to reverse course in 2026 due to renewed inflationary pressure, and there are several scenarios in which that becomes plausible, including trade policy disruptions, energy price shocks, or persistent services inflation, then the partial relief that lower rates have provided to the market disappears. A 50 basis point increase from current levels would push monthly payments on the median California home back above $2,900. That doesn't just stall demand, that kills it. And builders who are already operating on low sentiment, struggling with materials costs and labor costs and permitting delays, would pull back on starts in ways that exacerbate the long-run supply problem even as they provide short-term price relief. Let's also be honest about what this isn't. It isn't 2008. The structural conditions that produced the subprime collapse, liar loans, ninja mortgages, synthetic CDOs built on fraudulent underwriting, leverage ratios at banks that defied rational analysis, those conditions are not present today. Lending standards since Dodd-Frank have been materially tighter. The pool of deeply underwater homeowners, while growing, is not at the systemic scale of 2007. Foreclosure inventory is not spiking at a national level in the way that presaged the prior collapse. The comparison to 2008 is emotionally resonant but analytically imprecise. What we have is not a crisis of fraudulent credit. It's a crisis of genuine unaffordability. A market that ran too hot for too long on the fuel of pandemic-era demand shocks, remote work geography shifts, and historically cheap money, and is now correcting back toward whatever the new fundamental floor turns out to be. The question is whether that correction happens gradually, a 2 to 3 year plateau with modest regional declines, or whether a shock event catalyzes something sharper and faster. The shock event scenarios worth monitoring are specific. A major tech sector contraction in the Bay Area or Seattle, not a trimming of 10,000 jobs but a wave of 50,000 or more, would hammer California real estate in ways that no inventory constraint can absorb. A credit market disruption. If regional banks holding commercial real estate exposure face a liquidity crisis, could spill into residential lending in ways that tighten availability precisely when you need it to stay loose. A geopolitical shock that drives energy prices significantly higher would hit Southern California and the Inland Empire especially hard, given the commute distances and the income profiles of the households that moved to those areas precisely because housing was cheaper. Any one of those events, none of which is a wild prediction, all of which are within the range of plausible 2026 developments, could compress what might otherwise be a slow, grinding correction into something that moves faster and hurts more people more quickly. For the 1.1 million Americans already in negative equity, the distinction between a slow correction and a fast crash is largely philosophical. They're already living the impact. The question for everyone else, for the homeowner with 15% equity in Riverside, for the renter in Sacramento calculating whether to buy this spring, for the investor holding 3 short-term rental units in Scottsdale, is whether the next 12 months look more like 2011, a long flat bottom with slow bleed, or more like 2009, a faster, steeper repricing that creates buying opportunities but destroys balance sheets in the process. The most honest answer anyone can give you right now is we don't know yet. The data as of February 18, 2026 supports the slow correction thesis more than it supports the crash thesis. But the conditions for acceleration are present. The indicators to watch: February 2026 sales volume from C.A.R. and Redfin, the Federal Reserve's posture at the March FOMC meeting, whether Sunbelt builders begin announcing aggressive buyer incentives, those will tell us in the next 30 days which direction the momentum is tilting. If Sunbelt builders start offering 2-for-1 rate buydowns and $50,000 price cuts to move inventory, that's an industry-level admission that the demand floor they were counting on doesn't exist, and that repricing mentality tends to spread from new construction to existing sales, from Sunbelt metros to inland California, from one market to the next, faster than most people expect. What we know right now is this: the U.S. housing market in early 2026 is defined by a structural standoff: sellers who won't cut, buyers who can't afford to enter, and policy tools that have already been deployed and found insufficient. California sits at the intersection of a statewide affordability crisis that has been building for a decade and a regional price correction that is already underway in Riverside, the Inland Empire, and Northern California. The optimistic forecast from C.A.R. of a 3.6% rise to $905,000 may still materialize, but it requires a demand recovery that the current data does not yet support. Watch the next 30 days closely, watch the February sales reports, watch the Fed's March language, watch whether builders in Nevada and Texas blink. Because the thing about a market standoff is that somebody always moves first. And right now, the question is whether it's the buyer who finally gets desperate enough to buy or the seller who finally gets desperate enough to cut. In the next 30 days, keep your eyes on the February 2026 sales volume reports from C.A.R. and Redfin, Federal Reserve signals coming out of the March FOMC meeting, and whether Sunbelt builders announce incentive escalations, because any one of those moves resets the trajectory for everything that follows. If you want the real read on California before the consensus catches up, subscribe. No noise, just the data and what it actually means.